God morgon. My name is David Landerborn, and I'm the new Interim CEO for Techstep. I have a background from 25 years in the tech industry and the last 8 within mobile tech. I have had several leading positions in my career, and I have been COO and member of the Techstep management team since Q4 2022. I know from my history in mobile tech and being a part of the operational side of Techstep that we have a very strong offering to the market. Connecting business and strategy with a winning company culture has always been my passion. For Techstep, it is key to show the strength in our offering and at the same time attract and retain the best mobile tech talents out there to secure future success. Through Techstep, the customer can buy their mobile devices together with our software and services, helping the customer to make their core processes more efficient and sustainable. We proactively secure the customer's ever-growing and business-critical mobile ecosystem in a sustainable way and at the same time reducing cost. In Q3, we have continued the journey to make Techstep profitable by bringing the best and the broadest mobile tech portfolio to the market. Our success lies in being able to help customers with all parts of their mobile ecosystem, from just buying devices or advisory to an entire mobile solution. This is what we call the land and expand strategy. So let me take you through some of the highlights for Q3. Techstep's financial results keep moving in the right direction. For the 4th consecutive quarter, we have a positive EBITDA adjusted. Our net gross profit margin is up year-on-year from 29% to 33% due to a mix of higher margin software and hardware. The cost optimization program introduced last year has been successful and resulted in a substantial lower cost base in Q3 compared to last year, both related to operating expenses as well as investments in internal IT infrastructure. On the commercial side, Q3 is normally a slower quarter due to summer holidays. In addition, is the global market for smartphones still challenging, impacted by the economic condition, which is still driving lower consumer demand and extended purchase cycles. The recurring revenue base is up 5% year-on-year and 2% from last quarter, but the growth is impacted by weaker hardware as a service sales. ARR from own software at 111 million, up 12% year-on-year. The refinancing has secured our financial flexibility and gives us room to develop our position in the market. We see a positive cash flow from operations with a cash position of 68 million at the end of the quarter. I've only been a few days on my role as new Interim CEO of Techstep, but it's quite clear what our top priorities need to be in the near future. We need to materialize on the great success we've had with winning the 2 big frame agreements with Oslo Kommune and Sykehusinnkjøp. We have done a good job so far optimizing costs, but we need to continue to match the cost side with the income side. And with that, I will now hand over to Ellen, who will take you through more details of our financial results for the quarter.
Thank you, David. Techstep's results for the 3rd quarter is following the same trend from the last few quarters, where we see a decline in the total revenues, but with improving profitability. As the hardware market is highly affected by the downturn in the smartphone market, our hardware revenues declined by 24% year-over-year. The challenging economic condition impact customer demands and purchasing cycles, and although going into 3rd quarter, we anticipated that the demand would be improving in the second half of the year, the summer months proved remarkably slow compared to previous years. In the 3rd quarter, revenues from advisory and services declined by 15%, but this is entirely in the transactional revenues, such as consulting and one-time services, as we continue to see growth in the recurring revenues. There is still a positive development in our own software offering, and revenues in the quarter increased with 30% compared to the same quarter last year. The annualized recurring revenues from our own software increased by 12% leaving the quarter and are now at 111 million. The net gross profit decreased compared to last year with 7% as a result of the unexpectedly slow summer months. But as the mix in revenue changed towards higher margin services and products, the net gross profit margin increased to 33% from 29%. We are continuing to see results from the cost optimization efforts, as we, despite the decline in gross profit, see a positive EBITDA for the fourth quarter in a row. Operating expenses and personnel costs has decreased with 25% year-over-year. And EBITDA adjusted for third quarter was 12.8 million, which is an improvement of 13.6 million from last year, and an improvement of 45.4 million year to date. We are very pleased to see our profitability is improving, and that the turnaround the company has been through the last years is now giving results. But we are still not content, as there are further potential for efficiency gains, and this has been and will continue to be our primary focus next to strengthening our go-to-market efforts. Although we have seen a substantial decline in hardware revenues the last 12 months rolling, net gross profit has been stable over the last year and are now at 365 million, which is the same level as the third quarter last year. The development is primarily driven by the decline in hardware, while there's a continuous positive development in own software and advisory and services. Gross profit from own software increased by 21% year-over-year. Advisory and services increased by 4% year-over-year, but show a decline since last quarter, mainly affected by the slowdown in the transactional services over the summer. As mentioned, the smartphone market, as well as the general customer demand, has been challenging this year. And we see that the decline in hardware demand also affects the purchasing cycles for our other products and services. And the rollout of services takes substantially longer time than we anticipated before summer, in particular within our larger public sector customers. The total recurring revenue reflects the amount of recurring contracts we have running at the end of each quarter. It includes only contract which has been invoiced. Contracts which are under implementation with a customer but not yet invoiced is therefore not included. At the end of the quarter, we had 306 million in total recurring revenues, which is a 5% increase year-over-year. This is driven by 12% increase in own software and 16% in advisory and services contracts, while the hardware as a service is decreasing by 5% year-over-year. Last quarter, we reported recurring revenue from hardware as a service at the end of Q2 as 139 million. We have had to restate this number as we discovered that we had included one-time revenues into the calculation. The correct amount for recurring revenue was from hardware as a service at the end of Q2 is 122 million. The decline in hardware as a service this year is correlating with the general decline we see in hardware business. The annual recurring revenues from our own software is still showing a positive development over time. However, the sequential growth is only 1%, and so far this year the growth has been 5%. This is less than we anticipated and is a result of longer lead times for contracts to materialize from agreements already entered into. The larger frame agreements landed in the first half of the year include strong upsell potential for both services and software. But we see that it will take time to materialize. It is much longer lead times to implement new products and services, as the complexity in the agreements are high and the customer needs time to initiate and implement changes. As our main performance indicator, we use gross profit conversion to EBITDA, and we use pro forma amounts in order to show the underlying profitability. The current quarter shows 17% conversion rate, which is a substantial improvement from the same quarter last year, which showed -1%. To show the development over years, the last 12 months net gross profit conversion has increased from -9% third quarter last year to 6% at the end of this quarter. This improvement is due to successfully reducing our cost base the last year. Personnel and operating expenses has been reduced by 25% in the quarter compared to third quarter last year, while the year-to-date improvement has been 18%. The change is highly driven by the reduction in number of employees, which has decreased by 61 or 19% compared to end of third quarter last year. The cost optimization plan that was initiated in fourth quarter of 2022 targeted annual savings of 90 to 100 million compared to the 2021 cost base through reducing headcount, operating expenses, and investment spending. As of the end of the quarter, we are on target with our goals. In addition to reducing our operating cost base, we have also reduced investments in our platform and IT infrastructure. And as mentioned, we are continuing to focus on cost reductions. Moving on to our financial position at the end of the quarter. We had an equity ratio of 47%, up from 43% at the end of last year. Our non-current assets contain goodwill, customer contracts, and purchased and developed technology. The reduction from the end of last year is primarily due to ordinary amortizations. We have separated out the hardware as a service items that are accounted for in our balance sheet. On the asset side, 158 million is capitalized as assets or devices under hardware as a service contracts. On the liability side, we account for deferred or future revenue related to the same assets, as well as liabilities from buyback obligations. In total, the deferred revenues and buyback obligations were 190 million at the end of the quarter. Current assets, excluding cash, was 165 million and have decreased with over 100 million since 2022, which is due to last year ending balance consisted of one larger third-party software transaction that was settled in 2023. The same effect is on the accounts payable item in total current liabilities. In September, we successfully completed the announced refinancing of our bank debt. While the last of the seller's credit of 50 million was converted to shares in July, the remaining borrowings were related to acquisitions and various credit lines in the separate legal entities. With the refinancing, we have collected all bank debt, both long-term borrowings and shorter credit lines in the parent company, facilitating for more efficient liquidity management. The refinancing increased the share of long-term debt from 103 to 150 million, where at the end of the quarter, 135 million are classified as long-term net of financing costs. Short-term debt consists of an RCF and drawdown on overdraft facilities. There's been a positive contribution in cash during the quarter, and our net working capital, including cash, is positive with 16 million for the first time since the beginning of 2022. Our net interest-bearing debt at the end of the quarter was 137 million, up from 113 million at the end of the year. Overall, we are improving our financial position with a new financing in place and an increased focus on working capital and liquidity management. We are presenting our cash flow this quarter a bit differently in order to show operating cash flow, including the entire effects of cash from hardware as a service. Cash inflows from hardware as a service is included and in EBITDA adjusted and the changes in working capital. So in order to include the net cash effect, we have included the cash spent on hardware as a service and the cash gains from end-of-life devices in our operating cash flow. Third quarter cash flow from operations, including hardware as a service, was 39 million, which was an improvement of 15 million from third quarter last year. Year to date, there's an improvement of 46 million. We have a positive contribution of 16 million in working capital in the quarter versus 31 million last quarter. Cash used for investment activities contained primarily payments for investments in our software portfolio and IT infrastructure, and as a result of the last year's cost optimization, we have reduced the spending with almost 20 million year to date versus last year. Net cash from financing activities was 24 million in the third quarter and consists of 31 million in net inflow from drawdown on credit facilities and refinancing of bank loans in the quarter, in addition to payments of interest and leases of 7 million. In total, the net cash contribution in the quarter was 57 million, increasing our cash position to 68 million at September 30th. Then I'll leave the word to David, who will summarize and go through the outlook.
Thank you, Ellen. So let's summarize. Our key focus is to turn Techstep profitable, and all in all, we are on track. There is still some uncertainty in the macroeconomic environment that has resulted in somewhat longer lead times and more prudence on the customer side. We can now see the result materialize with growth and optimized cost from the extensive transformation process Techstep has been through the last years. For the fourth consecutive quarter, we deliver a positive EBITDA adjusted. We have come far, but there is still more to do. Going forward, we will continue to further optimize the organization and customer journey for faster execution on existing and upcoming contracts. In line with the restatement of ARR on own software in Q2 2023, and uncertainties relating to timing and ramp-up of deliveries under the major contracts awarded this year, we have revised the company's ambition for 2023. The updated ambitions for 2023 are an ARR of 110 to 120 million, net gross profit of 350 to 360 million, and EBITDA adjusted of above 30 million. When it comes to Techstep's long-term ambitions, they remain unchanged. And that concludes today's presentation. Thank you for your attention. Please join Ellen and myself in the Q&A session today at 0800. You can always submit your questions to us using the investor relations email address or during the session using the chat function.